in the broader market. I want to talk about some of the things that we tend to see in this environment and historically how things have changed when it comes to trying to predict if a market is at a top. There are 10 things that we had historically looked at, but there's one core driver that really seems to matter more than anything. Good morning, Rio. Good morning, Arturo, R. Haskin, and Connie 99. All right, so really quickly, let me just make sure that I am sharing my screen correctly, because you don't want to see too much of this old cowboy this morning. All right, so as we look at this right now, we'll talk about the morning checklist. We'll talk about reversal patterns and the cracks in the momentum. So again, we're up at 5:45 out here on the West Coast in Tahoe, and I'm doing this because it'll be too late if you are not up and with us at 8:45 every day, talking about the markets, talking about positioning, talking about what's happening. Because again, the exit of most funds and a lot of people who are setting up positions overnight and in pre-market, you're going to be their liquidity exit. And we saw that happen yesterday on the backside of that CPI report, the way that the markets changed, the way that the markets moved, and the way that things shifted after Wells Fargo reported earnings. And Wells Fargo's earnings report yesterday is probably the single most important earnings report that I've read in about 3 years. And I'm going to lay out kind of what's happening in the banking sector and one of the key warning signs of something that is starting to be a bit of a problem, particularly as we look at the current state of affairs for the U.S. financial system. We're going to show you where smart money's positioning using some of the flow analysis that we do. And we'll tell you whether or not today is safe or not. And right now, it's starting to feel like some air is coming out of this bubble. But the big question is, how sustainable will that be? Because my bias always remains to the upside: more capital, more liquidity, more rally. Here we go. Momentum is green. And this is interesting because, once again, broader market, the way that we measure momentum, the signal is green, even though our intraday reading looks bad. And this is kind of one of those first warning signs that we have to start to assess. We have to break it down and analyze it, because sector by sector, we're starting to see some issues, specifically in the energy sector. And I'll tell you exactly what I'm going to be shorting today as a result of this move on the energy side. Our energy went negative yesterday. And this is important because this becomes an opportunity to take a calculated shot to the downside on oil prices in the next couple of days. But what we're seeing right now is intraday momentum, the number of stocks breaking out versus the number of stocks breaking down. We are now in this negative 17 on our intraday. Now, once again, as I said, if we move into a negative event, a negative period, we flip over and we look at the FNGD. This is a leveraged ETN that has a lot of exposure to debt in the FANGs, right? The Magnificent Seven. And as we've shown, when this starts to break out, there is something wrong. There's something wrong with the leverage in the broader market. There's something wrong with selling patterns in the Magnificent Seven. When this starts to go, the market goes with it, particularly the S&P 500. But we are nowhere near breaking above that 50-day yet. We're nowhere near breaking above that 20-day yet. We're about 5.5% away. If we look at the S&P 500, just looking at the SPY, we're still hovering above that 50-day moving average and the 20-day moving average. We're 4.2% away from the 50-day moving average. And what I had noted on the weekend, we had just moved up the upper band of the Bollinger Bands on the S&P 500 last week. What that means is we were in extreme euphoria for about 8 days. The last time we were in that environment, we saw a 10% correction on the S&P 500. Why does this matter? Well, it matters because we can see some types of sell-offs and profit taking, as we've seen in the past, where we move down here, bounce off the 50 and turn right back around. But at this moment, we don't know if this is a broader issue or if this is just going to be a retest of the 20-day moving average before moving higher. We have seen in this strong momentum environment 2 retests of that 20-day moving average before we started to move higher. But all signs seem to suggest that we are on a pathway, probably down toward at least 618, if not 615 on the S&P 500. That would translate to around 6180, I believe, for the S&P 500. And then you have to kind of play the game from there. With that in mind, the one thing that does concern me is the Russell 2000 and whether or not the Russell 2000 is going to be able to maintain its momentum and hold above its 20-day moving average. The difference between the Russell 2000 and the S&P 500 is basically globalization. The Russell is a very strong reflection of the U.S. system, the U.S. Equity markets. Now, there is a little bit of a better tie here to the economy, but as we have noted, liquidity and capital drives asset prices, and there is a steep disconnect between the economy and the S&P 500 and the Russell 2000 right now. And I'm going to lay out momentarily at the end of this session about why you're going to probably see Fed rate cuts relatively soon, and resultantly how that's going to be positive for equities. But at the same time, we do have a lot of flashing warning signs in the economy that will need to be resolved through Fed policy, simply because weakness on the backside of this year. Now, as we look at this, the core thing to pay very close attention to with the Russell is something called the TZA. This is an inverse bear ETF. Same rules, everybody. This starts to break its 20. This starts to break its 50. Nothing good happens here. This is leverage leaving the Russell 2000. So at the same time, we are very close to this line. And if the Russell goes, we could start to see some additional problems, and it may be signaling issues involving rates here in the United States, default issues in the United States. It can mean any number of things, but I just keep an eye on this because this would be a sign of momentum breaking down. Strength. Oh boy, look at he's back, Mr. Saylor. And I wrote about this yesterday. If you see a finance bro in the wild, do not approach, because you will have a 20-minute conversation about MicroStrategy, Strategy Now, and Michael Saylor. Bitcoin continuing to move higher on crypto week. There is a lot of speculation, obviously, around these bills. This still looks like a risk-off event to me. MSTR is pure momentum. So is virtually everything in the crypto space. U continues to pop up once again. This is the energy fuels side. We're talking nuclear, huge move up in the last couple of days. These types of strong uranium moves, there's a lot of speculation around these names. There's a lot of speculation in the space. And I encourage you not to chase this type of stuff. But it's always a good reminder that when we get these pullbacks to the 20-day moving average, and definitely in the 50-day moving average range, the moment that we can crack the 50-20 and 50-20 and 200-day moving averages all at once, that has historically been a bullish period for these types of names. So just if you miss this first wave, we miss this second wave, give it some time. It's going to take a decade and a half for us to get that nuclear capacity up. But right now, a lot of speculation in the uranium space. SE has popped up as well. C Limited, one of these names that has just chopped around on the consumer cyclical side. This is a Singapore company, but very strong momentum when it gets above its 20 and its 50-day moving average. And we are just cracking above that right now. So a possible return back into the 160s and possibly back up to 170. What do I think now about MP? Well, did it crack under or below its 20-day moving average? Pretty good. Again, this is all about momentum, and another break higher on MP Materials. We've seen the same thing with some of these other names that we've talked about. Magna, strong momentum here. PALL, again, weaker dollar, strength in the palladium space. I obviously have no concerns about a company like MP, but at the same time, just remember, we are now overbought, and we get into that overbought territory. This is where profit taking can and will occur. 6.1% pop today. That's fantastic news for investors. On the weakness side, look, this all comes down to energy. And I talk about this quite often, but when the OIOU starts to break under its 20 and possibly cracking under its 50-day moving average, this is where I move against the energy sector. And there is persistent weakness now up in the oil and gas space, E&P. The entire sector has gone negative, particularly in the Russell 2000. So as we look at this, one of the ways that I like to tackle this is to start look at the names that have a little bit higher beta and start to take a little bit of a shot to the downside. Permian Resources is number 3 on that list of the name that I would like to attack. Staying in the money going out to next Friday, short duration, and legitimately just looking for a move on this, maybe down to 13, maybe down to 1275. I don't need to be greedy on this, but as you have seen, when we get under these different moving averages, I don't know whether it's funds that are doing it. I don't know if retail is trying to short it. All I know is that traditionally, more times than not, I'm getting at least a 1 or 2 day follow through on some of these names. It might just chop around a little bit. I'm going to keep a tight stop around the 20 to 25% when going directionally on a name like this. PR's on the list, Apache as well. Apache's a much higher beta, and I can see I would like to see this break down possibly into that around 1750 range, and then just get out of the trade. We have all these important indicators signaling, weakness. MFI, interestingly enough, moving higher, but that's a little bit unusual to see higher volume. But again, selling on this stock, ADX switch over, negative move on the MACD. On the daily chart. So I like this as a short as well, down into the 1750 level. I will probably buy the $19 put for next Friday and just look for a directional move. I will not enter this trade probably until 9:45 or 10 o'clock. I want to see if oil prices and energy stocks kind of gap up a little bit, as a result of just short covering, particularly around these moving averages. WHD and OLLI and LB are weak today as well. Looking at the other side of this, sort of get used to it. What are we talking about? Seeing what you guys are talking about. Cool. All right. KEN, NVGS, and YRN. KEN back on the watch list today. Kenan Holdings. This is one of those names that we've just seen strong breakouts. A lot of these international names, particularly in the power space, are starting to do better and better. That's what brought us that one's particular stock from South Korea. Stronger breakout move. NVGS is on the list as well. Navigator Holdings holding above its 20-day moving average. This is midstream. I would be a little bit cautious here, but it did pop up on our list. Just relatively solid, strong, smooth momentum. And RYN, which is Rayonier. Rayonier is a specialty REIT. I haven't seen this name in a while, but let's see if we can get above that 20-day moving average and then effectively use that as a stop. On the sector weakness side, energy stocks are starting to show cracks in the upstream E&P. This is important because this is more of a macro story than anything else. Technology, believe it or not, technology is weak. And this is actually something that a lot of people aren't going to pay attention to simply because the S&P 500 is moving higher. The Mag 7 is getting all of the attention that it is getting. But if we look across the entire sector on the tech side, you're seeing weakness. It's just not Nvidia. It's not Apple. It's not the names that you're used to. What it's actually are the companies that are in the software space, particularly. If we take a quick look at this and just assess the technology stocks, what you're going to see here is something that's a little bit surprising. So first off, on the Russell 2000 side, you have 12 stocks that are down 5% on the week, 5% on the down on the month. And beta is beta, but if you just go over 1, right, 8 stocks with a beta over 1, Accenture, Autodesk, CrowdStrike, Dayforce, Enphase, EPAM, Gartner, and Workday. But if you stretch this out to the Russell, it gets pretty significant pretty fast. 31 names and a lot of software names. Some of these companies you probably have never even heard of. Do you know what Expensify is? Do you know what Braze is? Do you know what SoundThinking is? The issue with a lot of these names is that they're not profitable. They're not exact. These are the zombie stocks, right? That we've talked about in the past, where they have a significant amount of debt. They're holding on by a thread. They have a little bit more balance sheet space for them to keep borrowing. But right now, when you have this environment and concerns about interest rates, this is where sensitivity really starts to show up and people start to dump some of this stuff. As we look at a lot of these names, you're not seeing the typical companies that we would see all the excitement around, right? The uh, the Magnificent Seven stocks. If you dig a little bit deeper into this and you go to the other side of it and you look at the number of stocks that are up on the week versus down on the week, you've got 11, right? So you have a lot of money at the bottom of the entire technology sector walking away. What that signals is that the people who have been holding these stocks, who are analyzing their balance sheets, who are concerned about higher rates or cracks in the financial system, they're dumping these names because they're not profitable, they're not strong companies. But the Mag 7 continues to hold this market up. And if we go back to 2021 as an example of this, the Magnificent Seven legitimately held the S&P 500 up the entire year, while the Russell basically just stayed choppy and flat and in negative momentum for the duration of the year. Um, Keep this in mind. Utilities are starting to show some weakness as well. This is a contrarian rate wording as well. And the consumer defensive stocks are negative, which I find this to be fascinating because that's typically a protective area through a liquidity cycle. It just shows that the Mag 7 is ruling everything, that the markets are climbing a bit of a wall of worry. So this is a very kind of difficult environment to navigate. But I'm starting to feel a little bit more nervous than I usually get, and my spidey senses around this market are there's some problems that are underneath the hood that we're not seeing just yet, but they easily could start to show up in the next 2 to 3 weeks. And this may be something that has nothing to do with the United States. If we go back and we think about what happened last year, we started to see selling right this time last year. And 2 weeks later, we had a massive crash in Japan. So I still remain very concerned about that. But nonetheless, I would just take a little bit of a step back and kind of reassess what's happening in the market. From the macro side, tariff-driven inflation and bond spikes. The CPI was up 0.3% on the month, 2.7% year over year. And inflation is showing the tariff effects, no doubt about that. We have a 10% yield, 10-year yield. That's not right. What are we? I left a number out. Forgive me. Bonds. We are at 4.5. Yep. We were above 4.5, which pressures growth stocks. Again, we saw that start to sell. 30 years, the elevated one. Pay very close attention to the dollar, DXY. The banking side, this is a little bit concerning. Morgan Stanley, strength on the trading revenue. Everybody's reporting strong trading revenue. Where are they not doing well? In actual lending. Banks aren't banks anymore. And I'll explain that in a moment. But once again, Nvidia pretty much driving everything. The AI trade remains strong, and we can see that in the SOXL. If you are looking for your warning sign on when there may be an issue within the broad market, SOXL is going to tell us. If this starts to break down, breaks under its 20, breaks under its 50, the leveraged semiconductor ETFs provide a very strong warning sign. Nothing really to phone home about yet, but certainly pay very close attention to this because eventually people are going to start taking profits. This has been a hell of a run for the SOXL. It's up more than 250% or 150% going back to April. And even though retail does not trade this stuff, a lot of institutions do, and a lot of momentum traders do. So pay very close attention to that. On the macro side, this is the issue. Wells Fargo cut its net income guidance, interest income guidance to flat. So despite beating their revenue expectations, the stock fell 5% because people are concerned about weak lending demand. Well, here's the issue. If I went into JP Morgan today and I said, hey, I need $500 million, they would say, yeah, we've got $500 million. But what if we did this instead? What if we found someone to give you the $500 million and we just take a cut? And that's legitimately what banking is now. They would rather generate revenue through loan origination to the private credit market and not have to take the risk on their balance sheet. And this is a result of regulation. So what you have here is Basel III, which is the ecosystem of the entire financial system. They went in and they said, we're going to make banking safer. So they created these regulations, and now it created incentives where banks don't want to even bank anymore. Kind of fun, huh? Isn't banking and finance amazing, everybody? So they go out and they lend all that. They go out and they get money from Apollo and Blackstone, and they do the lending at a 9 to 13% rate instead of what corporates are at around 5 to 6%. So now you've got all the systemic leverage and all of these concerns and all of this lending that is not even monitored by the Fed. The banks originating, it's not concerns about lending demand, it's about what the banks are actually doing. So this is an issue. The KBX, the banking index, has pulled back slightly. I know that some of us have been going back and forth on what's going on with regional banks. Pay very close attention to the DPST because all of the regional banks are going to start reporting next week. And if you wanted to be weak regional banks right now, I know that we saw this run. I've been talking about it. This might be the time. This could be a fascinating period for the banks. And we've seen that in the FAZ, the bearish ETF, this is starting to crack its 20-day moving average. That ain't good. That's concerning. So there seems like something's brewing. I don't know what it is yet. I have a feeling that it's abroad, but once again, the fact that banks aren't banks anymore is certainly a hell of a story. And I'll be talking about that a little bit later today. All right. I want to just touch on this, right? And these slides are going to be made available later today. We'll basically just provide it out. But somebody asked me yesterday, Garrett, like, what are the signals of a market top? Okay, well, here's the fun thing. Back in 2008, before 2008, back in 2008, when I carried an onion on my belt, because that was the style at the time, what worked as a market top no longer works. And what worked from 2008 to 2020 doesn't work anymore either. But let's look at a couple of these things, right? So the first thing is the idea of a extreme bull bear sentiment, right? This has worked in previous periods, and the composite investor sentiment, you see this on CNBC. It's got that kind of dial chart to it. And the idea is that over bullish extremes often precede corrections. Of course they do, right? Be bearish when everybody's bullish, be bullish while everybody's bearish. Well, the lead time on this historically had been about 1 to 3 months. That's the first thing. The second is credit market stress, high yield spreads. When high yield spreads over treasuries, tight spreads show complacency and rising credit risk. And the lead time on this is typically 3 to 6 months historically. And we're typically looking for above 250 basis points between those spreads as that danger level. The third is dealer gamma exposure. Don can talk more about this than I can, but the options market maker starts to hedge. What is that telling us, right? The idea here is negative gamma increases market fragility. And the way that I had seen this, some of the data that I had analyzed was about a 1 to 2 week period. It might even be tighter than that. I'm sure Don's probably in the chat room going, he knows exactly what the number is down to the day. The third thing was passive flow reversals. We track this on a pretty regular basis, but outflows of passive ETFs and mutual funds, that can trigger systemic selling pressure. We can see forced selling in this space. We can see concerns about individual stocks of whether or not they need to be dumped in order to rebalance. And this has had a very tight time as well, which is 1 to 3 weeks. In addition, QE adjusted valuation extremes. Now, this is a perfect example of something that doesn't work. But historically, we would look at things like the Buffett indicator, which would analyze the market capitalization of the S&P 500 to market valuation current. I did it backwards, but this is the Warren Buffett indicator, which is right here. See the full model. And it's dividing the total market capitalization divided by the annualized GDP. And then these standard deviations have typically signaled, that we are overvalued in terms of the market itself. We are at an all-time high on this, 200% ratio. But that said, it's not necessarily going to tell us going to happen within a month, 2 months. We've seen 6 to 12 months. So the other thing about this, and as you'll see momentarily, it's one of these things where people, if they're trying to short it based on this, you're going to be insolvent before the market catches up and rationality returns. So this is kind of a multi-metric overvaluation and a top warning. We're at a CAPE ratio up above 35. Market cap was around 196, 200, and forward PEs are high. So the market looks expensive, but the reality is, for the reason that I'll explain momentarily, the market can remain irrational longer than you can remain solvent. There's a speculation crescendo, the idea of speculation and euphoria and meme stocks and SPACs and crypto. The specific thing that we want to be looking at is the number of meme stocks as a percentage of daily volume. I don't have that number. I tried to track it down and I couldn't find that one that was truly reliable. But I just want to note that this is something that is that actually has provided an idea of sentiment shift. I've talked about this before. When things get really euphoric, when people start making, like Tom Lee saying 7,500 for the S&P 500, what will happen is the news cycle will flip, and in 2 weeks we're going to be talking about, D-Day on the issues built around the tariffs. And if that's the case, like if there's massive crowded speculation today, this can roll over very fast, because at the end of the day, the purpose of the market is to sell. And once sellers start showing up, that's where the euphoria and the sentiment starts to shift. This does not work anymore. Fed balance sheet deceleration. So the idea that the Fed is going to start reversing and reducing its balance sheet. Well, we've already cut from the top of 2021 from 9 trillion down to 6.7 trillion. The market's up. The market has been on a straight upward trajectory since late 2022 when the Fed started tightening. And even though we had that pullback in 2022, we reversed all those losses on the backside of the gilt crisis, which was a crisis in England where they had a crisis very similar to the Silicon Valley banking crisis, where their bonds, because the yield spiked, the banks and the pension funds could not dump the bonds without going insolvent. Now, traditionally, liquidity is what drives markets, but if there's less QE, there's less momentum. But as I'm going to show you momentarily, it's not the Fed that's driving the bus anymore. The lead time on this used to be 3 to 6 months. In fact, in late 2021, when this started, the real problems in the market did not start until around mid-2022, where we had the largest hedge fund sell-off in 15 years. And then ultimately, we did have the gilt crisis 3 months later. And within 4 months, on the backside of January 2023, the market started an absolute rally that had defied a lot of expectations, simply because people were expecting the balance sheet to continue to reduce, and that would drive the market down to, say, 3250. Instead, the market went up 25% in 2023 because of the new forms of capital that were entering the financial system. Fed communication pivot. This is important, but once again, in this environment, it's not as important as it used to be. This is a 2008 thing, definitely carried on through 2020, through the last decade. But the idea that we're going to shift our policy language, that they'll signal upcoming tightening, that they're going to show reduced support. This has been kind of that 3 to 6 month period historically. And in July, Powell saying that, conditions were too loose and there's issues around tariffs. The reality is this does not bear the weight that it used to have. Market breadth, this is important. Fewer stocks participating in the rally. And what we're talking about is where the Mag 7 is basically driving the entire system. So when you have a thin participation, there is a very significant vulnerability to that rally. And that's why we got to pay very close attention to market breadth, right? Pay very close attention to the number of stocks on the S&P 500 or all stocks above their 50-day moving average, above their 200-day moving average. When this number is dropping, yet the market is moving higher, that is a warning sign, right? And the lead time on this is anywhere from 30 to 90 days. But right now, 69% of S&P 500 stocks are above that moving day average. I think that's NYSE, NASDAQ, and Amex. Forgive me. So right now we're at 69. I think S&P is somewhere in the 60% range. VIX structure, complacency. Spot VIX versus long-term volatility structure. Low spot versus plus steep contango equals a complacency warning. Look, you don't even have to do any of that. Just pay attention to the UVXY. And if the UVXY starts to break above its 20 and its 20-day moving average, be on alert. If it starts to break above its 50-day moving average, you got a problem. This is really one of those things that you don't want to own unless it starts breaking out, but pay very close attention just to the VIX. Again, 20, 50-day moving averages. It's just a very simple way to track what funds are thinking, what funds are doing. And the lead time here says 1 to 3 weeks, but I mean, this can flip over quickly. It can be 2 to 3 days, as was the case last year with the Nikkei crash. Now, as I mention all of this, and I got 2 minutes, I just want to point this out. None of this matters. And for all of my Wu-Tang fans, cash rules everything around me. Global liquidity is at $180 trillion. It was at 165 2 years ago. Where's that money coming from? Well, 80% of central banks around the globe are easing, but it's the money markets and it's the companies that are in the private side that are creating all of this liquidity. A lot of these numbers are coming from Michael Howe at Cross Border Capital, but global M2 liquidity is 110 trillion. The global liquidity number, which is outside of the M2 with the shadow banking, is 180 according to Howe. U.S. liquidity policy has dominated the U.S. markets, and the global markets see the U.S. size of part of the MSCI going back to 2000. We are the dominant alpha of the entire system. Now, even though the U.S. economy is slowing, and as that continues, I showed that chart the other day, U.S. economic activity and global economic activity is dropping, yet the equity markets are going up as liquidity is going up. The Fed funds rate is probably going to hit 3 to 3.25%. And this is the funny part about it, right? We were talking about more rate cuts. They're probably off the table they were off the table last year. They're probably going to have to come this year, if not early next year, to help restore economic growth. At the same time, the Treasury Department has taken over the responsibility of the Fed by turning to short-term bills. Short-term bills and reducing the duration of U.S. debt creates more liquidity, which finds its way into the equity markets. So banks want this short-term debt because it enables a monetization. It enables them to go and work with the shadow banks and enables them to work with other forms of lending. And what ends up with is more capital flooding into the system. Since 2020, the overall injections into the global markets is going to be somewhere around the $8 trillion range from that side, not from the shadow banks, but from the Fed and from the Treasury bills. 4.5 trillion stimulus 2020, 1.2 trillion 2022, 2023 2.4 trillion, largely on the back of short-term T-bills. And Howe is now projecting another 1.5 trillion next year. So that's $8 trillion. And why does that matter? Because when liquidity expands, Bitcoin stocks and other growth assets go up in value. Higher tariffs are going to likely slow down growth. But here's the problem. That forces more rate cuts, which increases liquidity, which drives up risk assets. In addition, stable coins like Tether and Circle are going to be buying the Treasury bills. That's going to create more liquidity. And House basically said over and over again, look at the Treasury bill issuance. We're expected to go from 21% to 25%. That is cocaine for the markets. So we're going to have these short-term periods where we're going to have these kind of panics. We're going to have deep sell-offs. We're going to have the insiders start to buy, and the markets are going to take off again. Multiple Four Sigma events, multiple panics. But the reality is all signs point to the continued melt up and the continued higher moves into 2026. There's going to be these risk off periods, but the longer term, use these short-term panics to buy things that are high beta and can ultimately help separate you from the ongoing concerns that we have around inflation and wealth protection. It's 6:21. That was a little bit of a rant. That wasn't really a rant. Don is coming up in a little bit. I hope everybody has a good day. I will make sure that all of this stuff is listed on the blog. I am going to go for a walk because the sun is finally out. I hope you all have a great day. Have a wonderful day. Talk to you soon.